So let's go to page number 3.6 where we have the step by step how to present your profits and losses for the previous years. So what happens is that you take the profits as without any adjustment as it is, which is mentioned in the question. To this we will add some items, we will subtract some items. This I have already discussed in the previous video. So we add the abnormal losses, we add the losses on sale of fixed assets, then we add the overvaluation of opening stocks and undervaluation of closing stock, non-recurring expenses, capital expenditures, and we subtract abnormal gains, non-recurring incomes, overvaluation of closing stock, income from trade, non-trade investments, management cost, and any future expenses like insurance premium. So we are going to adjust this and then find the adjusted profit for the year, and then we find the average profit. So and then we multiply with the number of years of purchase, and that is how we arrive at the goodwill. So this is a simple method. Then we have something called a weighted average method, where you can just go to page number 3.11, where you can see that the steps are mentioned over there. We'll calculate the normal profit, the same method as the earlier method. So we take the normal profits and we select the weights that is going to be assigned for each year. Okay, and then what we do is we simply multiply the weights with the profits. We get the total of the weights profits, and we also do the total of the weighted profit. Okay, and then what we do is we find the weighted average profit by dividing the total of the weighted profits divided by the total of the weights. So then we find the goodwill. So we just simply multiply whatever weighted average profit we got with the number of years of purchase. We'll quickly go through one illustration so that we get an idea. If you see illustration 8, everyone, on page number 3.12, so they have given the profit as 40, 48, 60, 50 and 36, and the weights assigned is going to be 1, 2, 3, 4 and 5. So when we take the profits 40, 48, 60, 50 and 36, and the weights are 1, 2, 3, 4 and 5, and the weighted profit is going to be, just you have to multiply 40 with 1, 48 with 2, 60 with 3, 50 with 4, 36 with 5. So you arrive at the weighted profit and you take the total of the weight as well. Then we get the weighted average profit, which is the total of the weighted profits divided by the total of weights. So 6,96,000 divided by 15, which is 46,400, and this will multiply with the number of years of purchase. So this is how we find the weighted average method for finding the goodwill. The next method is super profit method. So super profit method, we have to simply find the difference between your profits and the another profit, which is what I simply in the classroom discussion I tell the example that you are going to compare your profits with your friend's profit. Your friend is going to earn something called normal profit and you are going to earn something called average profit. So when we compare both of you, okay, if the average profit is going to be more, your average profit, that is average profit is mine, normal profit belongs to the friend. So if my average profits are going to be more, that is called super profit, and with that I'll multiply the number of years of purchase. Okay, now coming to the point how to find the normal profit. So normal profit, what we do is we multiply the NRR percentage with the capital employed. NRR with the capital employed. So capital employed, how to find capital employed now? So there are two methods, two approaches we call. On page number 3.13 you can see liability side approach and asset side approach. When we go to the liability side approach, you take from the liability side. On the liability side, what all things you have? Capital, reserves. Capital and reserves. These are the two items. But we have to exclude three items every time. What are they? Goodwill. You have to exclude fictitious asset. You have to exclude non-trade investments. You have to exclude what? Goodwill, fictitious asset and non-trade investments for finding the capital employed. While seeing the asset side approach, you take the total of the assets, all the assets. Again you have to remove the goodwill, non-trade investment and fictitious asset minus outside liability is what you have to do. So you get the capital employed. You multiply your NRR and you compare that with the average profit. You get the super profit. It is as simple as that. Okay. So we can just see quickly, we can go through one illustration, which is example, with 3.13 page number, you can see over there they have given an extract of the balance sheet where they have mentioned the assets and liabilities, and then we'll first do liability side approach. So we take the capital, which is Aman Bhaskar's 1 lakh, general reserve 90,000, and we are going to exclude fictitious asset, that is advertisement suspense, 10,000, and we are going to exclude goodwill 30,000. So we'll arrive at the liability side approach, capital employed will be 2.5 lakhs. Otherwise, we'll do the other method, that is asset side approach. We'll take all assets 3,90,000, we'll exclude fictitious asset advertisement suspense 10, goodwill 30, sundry creditors, which is outside liability, minus 90, and outstanding expenses 10,000. So we arrive at capital employed as 2.5 lakhs. So either ways you are getting the capital employed as 2.5 lakhs. On this we'll apply the percentage of NRR, we get the normal profit, we'll compare that with average profit, the difference is super profit. Clear? Okay. So now what happens is that sometimes it is very difficult. Okay. So we'll quickly see the steps for calculation over here. You can go to page number 3.15. So we'll calculate the average capital employed. Average capital employed is nothing but your opening capital employed plus closing capital employed divided by 2. So as already we have discussed about the capital employed formulas, then you calculate the adjusted profits, that is you do your average profits with adjusting your abnormal gains, losses and recurring expenses that have not been incurred. Then you find the normal profit, that is your average capital employed, you multiply with the NRR divided by 100, and then you step 4 you do your super profit, which is nothing but your average profit minus your normal profit, and then step 5 you get your goodwill, that is your super profit with the number of years of purchase. So it's very simple method. Okay, super profit method. It will be interesting if you understand it correctly. And then we have one more method, that is capitalization method. You can go to page number 3.19, where you can see there are two methods I have mentioned: capitalization of average profit and super profit. See, both the methods are different in the sense that the first, that is the average profit method, capitalization, you will get the goodwill by just comparing your capitalized value with the net assets. Okay, so let's see one by one so that you will get the clarity. Number one step is that you find the average normal profit, same way as we did the earlier method. Then we calculate the capitalized value. Now actually from capital employed only you arrived at the normal profit. Now what we are doing, from normal profit we are coming to the capital. So capitalized value of the business is nothing but you have to do the ulta. So average profit divided by NRR into 100. Okay, earlier what we did, capital employed into NRR by 100, we got the normal profit. Now what we are going to do, we are going to take the profits, average profits, and we are going to divide by NRR into 100. So we get the capitalized value. With that capitalized value, we are going to compare the net assets. Net assets is nothing but all assets other than goodwill, non-trade investments, fictitious asset at current value minus outside liability, and you compare them. When you compare them, you get a difference which is nothing but goodwill. Okay, now this is average profit method. Now we will quickly see the super profit method as well. Super profit method is slightly different in the sense that it is not the same as the average profit method. Here what you have to do is you have to find the capital employed, that is your all assets minus outside liabilities, and you calculate the normal profit of the capital employed, that is you take the capital employed with the NRR by 100. Then as usual you calculate the average profit of the past years, you compare them both, that is super profit. Till this step already you know. Okay, the next step will be goodwill is equal to super profit into 100 by NRR. Okay, this is the only change in the step in this method. You have super profit into 100 divided by NRR. So you arrive at the goodwill. So this is the second method, which is capitalization of super profit. So we'll quickly do one illustration 20 so that you get an idea. So the average profit of the firm is 1,50,000. The total tangible assets is 14 lakhs and the outside liability is 4 lakhs. And in the same type of business, the normal rate of return is 10%. So same type of business, it is going to be, like I said, the friend's business is 10% of the capital employed. So now first we find the capital employed of our organization, which is 14 lakhs minus outside liability 4 lakhs. So totally is 10 lakhs. So 10 lakhs into 10 by 100, we get the normal profit of 1 lakh. The super profit will be what? Average profit minus normal profit. So 1.5 lakhs minus 1 lakh is going to be 50,000 is your super profit. Till this everyone knows. Next, goodwill will be super profit divided by NRR into 100. So 50,000 into 100 divided by 10, which is 5 lakh will be the goodwill. So here we come to the end of goodwill chapter. Next we'll start with the PSR.